how is it that we identify an investment which will likely lead us to an above average rate of return? What are the characteristics, and what kinds of businesses earn above average rates of return? So we like to fish in the pond of high return businesses. And so it makes it much easier for us to get our focus up front. So in my office, for some really unknown reason, I had on the desk an old-fashioned milking stool. And it had come to me through my father, and it had come to him through a business partner of his. And on the top of this platform, it stands about that high, and it has 3 legs. And the first 2 are in the front, and the third one is in the middle and the back. And a farmer who was milking his cow and sort of just stick it up under his behind as he sat down to milk a cow. This was in the old days when they did it by hand. And so I was looking at that one day, and I thought, that's actually a perfect construct for our notion about what makes a valuable investment. We call it the 3-legged stool. So if you looked at our material is resplendent with these 3-legged stools. And we just use this as a shorthand version, a construct, to help us think in very simple terms about how you find these great investments. So the first leg is this issue of a high return business. We start with the notion of what kind of returns on capital does that business earn? What is the typical net margin of an American business today? In percentage terms, what would you say? I'd suggest that most people answer it's probably in mid or upper single digits. All right? And an investment that we own on is MasterCard and Visa. And does anybody want to guess what the net margins of MasterCard, Visa are? 40. There you go. So they're in the mid-30s. And you could cut that in half twice, and at worst it would be an average business. It's extraordinary. And I actually was talking to some people about this at the Munger meeting the other day, people who are well-schooled in the market and good investors, and they had no idea. They just didn't think of it that way. But that happens to be the way we think about it, because we have this little idea that our returns will be affected by the quality of the business and the rate at which it can grow the economic value per share. So by the way, in MasterCard, I can come back to it, but it also then causes us to spend a lot of time trying to figure out, well, why is that so? What is it about the essence of that business that allows them to earn returns that cause them to have a big bullseye on their back, that everybody, all other companies want a piece of a business that has returns that are that high? The average business earns, call it 8% after tax on earnings, and MasterCard earns 34%. That's exceptional. Even if the average were 10% would be exceptional. But MasterCard's 34%, my God, it's really incredible. So the first leg of the stool that we talk about is the quality of the business enterprise. And we spend a lot of time going down this road that we call, what's the essence of this business? What is it about the business that's causing this unbelievable rates of return to occur? The second leg of the stool then goes into the operations. It has to do with the people who run the business. And the shorthand version of that is we want them to have both skill and integrity. But what we say is that they've got a demonstrated record of being just killers at operating their business. But in addition to that, they treat us as partners even though they don't know us. And it's a really important idea, because the reverse of that is somebody I heard described the other day is talking like Warren Buffett and acting like Ronald Perelman. And there are people out there, and you'll find them, you'll run across them, who do whatever they can to make sure that public shareholders don't get their fair share. And we don't want that. We want the same thing happens at the company level to happen at the per share level. And that these are wonderfully skilled operators as well. So first leg is the quality of the business. The second leg is really the quality of the people who run the business. And then the third leg is the issue that really helps create the value, and that's the reinvestment. And there's a book out pretty current now called Dear Chairman. And it's about activists and companies and trying to change the behavior of companies typically because of their reinvestment histories. And if a business has a great high return on the owner's capital, we would love for them to be able to take all the free cash they generate and put it back into that business to continue to earn those high rates of return. It's way more efficient than paying us a dividend, and that's what creates the compounding effect. And when I get around to compounding, I always use the example, you all have seen it on the web, about the penny. And so I'm going to ask this engineer right here, would you rather have in this hand $750,000 or a penny doubled every day for 30 days? So you want the penny, right? And I knew that. So instead of $750,000, I'm going to make it $2 million in my right hand versus the penny, doubled every day for 30 days. You still want the penny. So I figured that. How about 2,000,001? Now, who knows right off the top of the head what that figure is?
10.8 million.
Yeah, it's 10.8 million. And so the simple arithmetic is it's 100% return for 30 periods, And that's the power of compounding. And so the really great thing about compounding, I tell people, is, if you have a stock that's going up 10 times, the next time it doubles, it's going up 20. And the next time it doubles, it's going up 40 times. What? Compound interest and compound return is just, it's staggering. Actually, I have a correspondence with Warren Buffett about this, and he always has said, as it relates to compounding, either you get it or you don't. And I wrote him a letter and I said, that was not my experience. My experience was I didn't get it until I experienced it. And that goes to this whole issue of investing. I have never been able to learn from other people's mistakes. I have to make my own. And so this process is designed to help me and my colleagues and partners have focus as it relates to how we're going to invest. Contrary to that is everything you see on the TV in the morning on Squawk Box or all those things. And they have a different business model. And their business model is mostly supported by financial institutions and other consumer institutions who want your eyeballs. And if it's a brokerage firm that's sponsoring it, the definition of a broker is to create transactions, right? You're advertising people, they want to create transactions, right? And what's the best way to create a transaction in the brokerage industry? Create what I call false expectations. And the false expectations are the notion that XYZ company earns $1.37 in the quarter. And the first thing that happens when they release their quarterly reports is everybody comes out and says, oh, they earned $1.38, they beat by a penny, you better buy it. Or they earned $1.36, they missed by a penny, you better buy it. Well, if you stop and think about it, unless you're very adept at trading the market on a daily basis, it's a sure loser for you. It's bad for your economic health. And as it relates to trading the market on a daily basis, there are very powerful computer algorithms out there using all kinds of information not available to most of us that are competing against you. We try very hard to be investors in the value of businesses as opposed to speculators in the price of shares. Now, do you remember what a penny doubled every day for 30 years is? Don't lose sight of that. So we tell our clients and our prospective clients that our goal is to compound their capital at an above average rate while incurring a below average level of risk. So let's start with the back end of that. What do we mean by a below average level of risk? Well, the businesses we own typically have the following characteristics. They have more growth. They have higher returns on capital. They have stronger balance sheets and frequently lower valuations than the market. So on their face, they're less risky. It's observable. It doesn't have anything to do with volatility, because our belief is volatility is a risk only in the short run. If you have an obligation in a year to buy a house or to do something like that, you probably don't want to speculate with that cash that you have set aside for that. But if it's 5 years or 3 years, you have the ability to put that money at work and have it work for you. So volatility is not in our lexicon, basically, in terms of risk. And we've already talked about what average is, and we think average is roughly high single digits, maybe low double digits. It means to us over a period of 5 years or 10 years, our returns are very likely to be well above that number. And it has to do with what the overall interest rate environment is. And so there are lots of investors, Michael Steinhardt and people like that, who retired with records of very high rates of returns. And finally, there is no correct answer. There is no correct way. This is just the way that works for us. I'm happy to have the opportunity to share these few thoughts with you.